Most people think the only way to save on taxes is to hire a better CPA or send a bunch of money to their 401k. But what if I told you that there's an investment that you can legally wipe out a massive portion of your tax bill, while also paying you monthly cash flow distributions from real American energy production? That's exactly what working interest oil and gas investments do. Welcome back. My name's Jaden Sharples. I'm the Director of Private Equity here at Norwood Energy Corporation. And today I'm going to break down for you how the top 1% use this little known tax code that allows you to build passive cash flow, offset active income, build generational wealth, all backed by real US energy. Before we dive into the video, I want to let you know that I'm going to leave a link down below in the description to my personal calendar link. So if you're a high net worth individual who's looking to get tax deductions, looking to build cash flow, or has any questions on the oil and gas business, you can go ahead, click that link, book a one-on-one call with me directly, where we can dive a little bit deeper. Oil and gas business can benefit you. Now, first step, let's actually define what a working interest investment actually is. When you invest in an oil and gas working interest well, you're not buying stock in an oil company. You're buying direct ownership in the production of the oil and gas well, a share of the actual barrels of oil or cubic feet of gas that come out of the ground. That means you participate directly in the revenues from the oil well, and you're eligible for the same tax deductions that the operator of the oil well receives. Unlike publicly traded energy stocks, this is a real tangible asset, and the IRS treats it very different. Now let's jump into the good stuff, the tax deductions that you receive with oil and gas investments. There are two main categories that you need to understand, which is intangible drilling cost and tangible drilling cost. Intangible drilling costs. These are all the non-salvageable expenses that go into drilling a well. Things like labor, mud, fuel, geological services, any chemicals that were used to drill the well. All of these things are considered intangible drilling costs. Now here's the key. 100% of your intangible drilling costs are actually going to be deductible within the first year that the investment was made. That's right. If you invested $100,000 into a qualified working interest program, roughly 75 to 85% of that, the intangible portion, could be deducted immediately against your active income. So if 80% qualifies, that's an $80,000 tax deduction that you can use against your active income. For someone in a 37% tax bracket, that's nearly $30,000 saved right out of the gate the investment was made. And then we have the tangible drilling costs. The remaining 15 to 25% is considered tangible drilling costs, meaning the actual physical equipment like casing, pumps, or the wellhead itself. Now, tangible drilling costs can't be expensed all at once, but the IRS does allow them to be depreciated over a period of 7 years. So you do get ongoing deductions each year that the equipment ages. Now, third, we have depletion allowance. Now, once the oil and gas wells start production and they start producing, the IRS allows an additional deduction called depletion allowance. Now, this is going to be typically 15% of your gross income from the well. This is going to be ongoing. So that means as long as the well is producing, a portion of that income from the well is going to be shielded from taxes every single year. Number 4 is active income offset. Here's the part most people don't know. Working interest income and losses are all treated as active income. That means that those first year tax deductions can offset things like W-2 wages, capital gains tax, business profits. Most passive investments can't do that. So while your friends are stuck with rental losses that they can't use, your oil and gas deductions can offset your real income today. Now, I want to give you guys a real example of what this looks like when investing in oil and gas. Say an accredited investor puts $100,000 into a new oil and gas drilling program. Roughly 80% of that is going to be the intangible drilling cost, which you can use in the first year that the investment was made. So an $80,000 deduction in year 1. And then the tangible drilling cost is going to be roughly 20%. So $20,000 of the $100,000, which the $20,000 is then depreciated over 7 years. If that investor makes $400,000 a year in income, that $80,000 tax deduction could save them roughly $30,000 a year in federal taxes. Now, once the wells actually start producing, often 35 to 45 days after completion, they start receiving monthly cash flow distributions based off of their working interest share in the oil and gas project. So essentially, they've reduced their taxable income while also creating a new stream of cash flow. Now, in the oil and gas industry, one of the most critical things that you can do as an investor, especially somebody who's new, is make sure you are partnering with an operator who has a lot of experience, who has a track record of being successful in their drilling projects, and that can also deliver the results that they're telling you. So if you're a high income earner, tired of watching 40% of your income disappear to taxes every year, oil and gas might be the smartest play to add to your portfolio. You can own a real piece of American energy, receive monthly income distributions, and take advantage of the same tax breaks that billion-dollar companies use every single year. Now, if you'd like to learn more about the oil and gas business or even see what opportunities we have here at Norwood Energy Corporation, I left a link down below to my Calendly. Please go ahead and book a direct call with me. I would love to jump in to the oil and gas business and explain it a little bit further if you have any more questions.